How to find the next Nvidia part 2. So if we're going to find the next Nvidia, we have to understand what are the characteristics of top performing stocks. The approach we're going to take is we're going to take two approaches that both show the ability to outperform, and we're going to blend them together to create our list. We're going to use O'Shaughnessy's trending value list, which is essentially a list of value stocks that are in an uptrend. And we're going to use the Investors Business Daily William O'Neill model of top relative strength stocks with strong earnings per share. We're going to take those two, we're going to blend them together to create our list. By doing so, this overlap will give us a list of stocks that have a PE to growth rate that is relatively undervalued, 70% or less of the growth rate. And then we're going to have a list of top relative strength earnings per share stocks. And this combination of top relative strength is associated with momentum, and earnings per share helps us find the quality in stocks. Our research suggests that while the O'Neill Investors Business Daily top relative strength, top earnings per share stocks will identify the top performing stocks in any market, they also tend to have high beta without high alpha. So what this means is if the market's super strong, they go up a lot. But if the market's bad, they go down a lot. Essentially, we're just simply adding leverage when we trade these names. However, the share of the O'Neill list that is undervalued compared to its growth rate shows very different characteristics than the list in general. This part of the list clearly adds alpha, and it outperforms in both good and bad market backdrops. The O'Shaughnessy trending value list helps find undervalued stocks that are trending higher. However, if we go into O'Shaughnessy's list and we look for names that have strong earnings growth and top relative strength within the list, they outperform for longer and with more vigor and they also maintain the ability to outperform in both good and bad market backdrops. By seeking to find the overlap between these two methodologies, between these two components, we tend to find top relative strength leaders that have earnings fuel behind their gains, yet they are still undervalued. As such, they can rise with strong earnings growth and with valuations as the market goes up. So this list tends to do better when the market goes up and when it goes down. The overall edge of this method outperforms the S&P by an average of 4% per year in bull markets. It's averaged 10% a year over the last two bear markets. So think about this. It's been going up during bear markets, the bear markets of 2000 to 2002 and 2007 to 2009. In other words, in real time, including slippage, which a lot of other services don't count slippage, the lists have outperformed consistently in both bull and bear markets for over 25 years. How to find the best performing stocks. So now that we understand the philosophy behind momentum stocks and behind finding stocks that are undervalued that are momentum stocks, now let's get into the specifics of how we find these names. We've mentioned this idea of the growth rate. Well, we're going to talk specifically about the PEG ratio. The PEG ratio is the price earnings or PE to growth ratio, known as the PEG ratio. What it does is it divides a company's PE ratio by its earnings growth rate over a specific period. What this does is by looking at this ratio, it strengthens the quality of the stock. A lot of people just look at PEs, but PEs don't always tell you the true story behind a stock. This valuation measure is a way that investors can use a broad assessment of the company's performance and evaluate investment risk. So this is right out of Investopedia. We put the link down here for you if you want to read more about it. Now let's talk about how we calculate the PEG ratio. Calculating the PEG ratio. To calculate a stock's PEG ratio, you must first figure out its PE ratio. The PE ratio is simply calculated by dividing the per share market value by its per share earnings. So it's going to come out in a multiple. And then from here, the PEG ratio is simple. It's just the PE ratio divided by the growth rate. So Investopedia defines it as the earnings growth rate over 5 years. We're going to do it a little bit differently. Let's work through an example of the PEG ratio. Let's compare two stocks of companies in the same industry. Company Y has a PE ratio of 15. Company Z has a PE ratio of 18. So looking at the PE ratio, company Y is the cheaper company. Now, when we bring in the PEG ratio, we're going to look at the growth rate. So company Y has a projected 5-year earnings growth rate of 12%. Company Z has a 5-year projected earnings growth rate of 19%. So to calculate the PEG ratio, company Y has a PEG ratio of PE of 15 divided by growth rate of 12%, or 1.25. Company Z has a P ratio of 18, but is divided by the growth rate of 19%, giving it a PEG ratio of 0.95. So even though company Z has a higher PE, it has a cheaper PEG ratio and would be the better valuation buy. The way that we look at it, our ratio for the PEG ratio is it's going to be considered to be undervalued if the PEG ratio is less than 70%. And rather than use the 5-year earnings growth rate, we're going to use the lowest growth rate in the last 2 quarters, the lowest of the growth rates in the last 2 quarters. So we have 2 simple steps to finding the top performing stocks. This two-step process will find stocks that are strong relative to the overall market, have strong earnings per share, and are undervalued. They're undervalued compared to their growth rate. So step 1, we take Market Surge, which used to be MarketSmith. We take Market Surge, or you could just get our service, and we scan for stocks that have earnings per share greater than 80 and relative strength greater than 80. This will reduce that whole universe down to a list of 200 to 300 names. Now, once we've done that, go to step 2. Step 2, we do an earnings scan. So we're going to look for 2 types of earnings. One, we're going to look for turnaround growth. These are companies that have been losing money but have turned it around. So we're looking for companies that have turnaround growth of greater than 70% in the last 2 quarters. So they were losing money, but now it's positive. Okay, so we're going to take the lowest of those quarterly earnings growth rates. Remember, they both have to be over 70. The PE must be 70% of the lowest growth rate of the last 2 quarters. If it is, then it's considered cheap by the PEG ratio and it goes on our list. The second way we do is we call consistent growth. And these are the ones we tend to do the most. In consistent growth, we're looking for a company that's grown at 25% or greater over the last 2 quarters and has a 5-year growth rate greater than 25%. So these are stocks that are growing consistently over a long period of time. Here we're using the PEG ratio by comparing the lowest quarter of the last 2 quarters versus the current PE. So let's work through an example. Let's look at GoDaddy, a stock that's currently on the list. GoDaddy has a PE of 13. The last 2 quarters growth rates are 820% and 87%. So if we're looking at the lowest, the last quarter, which was 87%, is the lowest growth rate. So we take the PE of 13, divide it by 87, which is the lowest growth rate, and we get 15%. Well, of course, 15% is much lower than 70%. So GoDaddy is really, really cheap relative to the valuation. Let's look at some examples here. These are stocks that are actually on the list. The first is Abercrombie and Fitch. You can see with Abercrombie and Fitch, this stock has moved from 20 to almost 200 to 192 over the last year and a half. The second one is Welltower. You can see that Welltower has moved from 92 to 120. The third example, which we've been talking about, is Nvidia. Nvidia has moved essentially from 26 to 130. Another big one on the list has been Progressive. Progressive has gone from 140 to 240. Another example from the list is Coop, Mr. Cooper Group. We can see that Coop has gone from 50 to 92. And lastly, another name we have on the list is ADMA Biologics. You can see ADMA has essentially gone from 5 to 18. These kind of stocks are on the list every month. What ultimately is a big factor in this is what is the overall market? Are we in a bull market? Are we in a neutral market, a choppy market, or a bear market? Well, of course, we've been in more of a bull market, so that's helping these names. But remember, the research will show that these names will outperform in any environment. So if we're in a bear market, they tend to go up a little. If we're in a bull market, they tend to explode. So there you go. We just showed you how to find the top performing stocks in the market. This is a method that's held up over 30 years. It's held up in bull markets and bear markets and in financial crises and war and COVID and all these other situations. It is a time-tested method. So what day is it? Yeah, it's Tuesday. And it's not just any Tuesday, it's Trader Tip Tuesday, where I come to you with tips and tactics like this to help you take your performance to an elite level. Could you see yourself trading stocks like this and being an elite level? Yeah, you could. And that's why you watch Trader Tip Tuesday. So I will see you next Tuesday.